How's it going out there? It's September 6th. I'm Frank Curzio, it's the Wall Street Unplugged podcast where I break down headlines and tell you what's really moving these markets. Hopefully you enjoyed a nice, long weekend. College football starting. Pro football starts next week, which is the greatest thing in history, which is awesome. But now it's back to work. Summer kind of officially over. And I'm starting to get a lot of questions because of my last monologue, where I told you I'm nervous about the markets. So the Fed is clueless, looking to raise rates significantly from here while shrinking its balance sheet at the same time as what? China is in horrible, horrible shape. Horrible shape. Europe is even worse. U.S. indicators showing clear signs inflation is moderating. Velocity of money levels not seen since the Great Depression, when money is clearly flowing out of the market. The Fed's achieving its goal, although they're not admitting it. The housing market weakened significantly, where even going forward, we're not going to see, oh, wow, housing's going up and another leg up. No, there's few people taking out mortgages with rates over 4.5%, 5%, and now over 5.5%. They almost pushed to 6%. And remember, the Fed wants to go higher and higher here. Look what's going on with the 10-year. How high it is, 3.3. The 2-year, forget it. Unbelievable, showing signs of recession, right? Because it's inverted. PMI services, terrible, horrible number. You say, Frank, well, rent, yes. Rent, big component of CPI, is going to stay high for a bit. So will food. Not all food. We've seen that roll over as well. Let's explain that in a minute. We've seen energy roll over. And there's lots of bulls out there. Lots of bulls, and they make a great case looking at supply, demand, imbalances and what's going on. I covered oil for over 20 years. I visited major shale areas. I talked to people who are much, much smarter than me. And there's one certainty when it comes to oil. That oil always, 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 always adjusts. It's a cyclical market. It's the ultimate cyclical market. Will higher prices result in many people all over the world finding ways to cut back? And they do this every time the price of oil surges. Every time. You can say, well, uranium's cyclical and corn is cyclical or this commodity is cyclical. It's not like oil. And oil, hits our wallet immediately, right? With gas prices, energy prices, electricity price. It hits us immediately and we adjust. We always adjust. We saw it. We're seeing it in demand numbers. Now, you're right. When it comes to Russia, when it comes to shutting off, which isn't a real supply, that's surprised that they shut off oil, right? Most analysts knew that was going to happen. This is on the table or in the works for over a month with Russia, saying that maintenance is causing it. Well, we know it's not maintenance. But let's see what happens. Because when we're looking at oil as it goes higher, people adjust. Could I be wrong on this? Absolutely. Absolutely. But you're looking at oil coming down pretty sharply. And not only that, hurricane season. What happened to hurricane season? Non-existent. Non-existent. No hurricanes. 3 storms named. I'm afraid to use that term non-existent. Given that I live in Florida, I don't want to jinx it. But 2 straight months from July 3rd to today where there's been no hurricanes named. Those storms. And if you look at August specifically, this is the first time, just to put this in perspective, because I had to look this up, in 25 years, where in August there have been no hurricanes named for the month. In fact, if you date back for 7 decades, this only happened twice, 2 other times. The hurricane season extends through November, and we've gotten very bad hurricanes. I'm not saying that, everything's cool, but when you see hurricanes come, it's a nice pop in energy prices usually. And we don't have that either. Again, that's temporary, and we see that adjust just like we see it seasonally in terms of the holidays in the summer and more driving and stuff like that. But people adjust. They do. They adjust. I adjusted. Hell, we're going to rent because, gasoline prices, even at these levels where, whatever, they're 25% lower than they were, 30% lower than they were. They're still much higher than they were a year ago. But we're like, F it. I'm going to get an apartment near our house that we're building and make it easier for us. My wife will stay there. I'll go there at night, on and off, back and forth. We're adjusting. Everybody's going to adjust because you can't afford it. You can't afford it, especially when you're seeing your portfolios down 20% plus, they're down 20% plus. If you own any growth names, if you outperformed or did well in the market in the last 10 years, chances are you own a lot of the FANG names, which are all getting crushed. Technology's getting crushed. Nvidia's getting crushed. If you own the S&P 500, yes, you're down like 12, 13, 14%, whatever it's down right now. And then you see your home price coming down, right? Psychologically, you're like, wow, sentiment-wise, I need to slow down. And oil's one of the things you slow down. But oil's under $90, $87. It was over 123 months ago. Close to a 30% decline. Fed says we see no signs of inflation slowing, right? Copper's down 22% over the past 3 months. Corn is down 20%, although it has popped off its lows. This is all the past 3 months. Wheat's down 35% the past 3 months. I mean, you're looking at lumber. Holy cow. Lumber's absolutely crashed. Down 65% since March, down 40% in 3 months. I don't know where demand for lumber is going to come from with the housing market crashing, and home builders are not clearly, after this cycle, which, they're building, and what's keeping prices a little bit elevated, not completely crashing, is because we need more homes built, but they're slowing. Just listen to the calls. They're slowing. They're adjusting. They're used to these markets. They lived through them before. They almost got destroyed in 2008. They got bailed out under the table, under the table. When they were allowed to report those losses, those years' losses, where you can count those losses to gains, that got extended to 3 years. That's why home builders were one of the biggest buys. I remember researching that, and then I'm telling Kramer, 2010-11, I wasn't there anymore. He's like, holy shit, did a whole segment on it, mention me. He's like, this is incredible. Those things just surged. It's a pretty big deal when you could take 3 years of losses against, all the profits that you're going to generate, which profits surged. Maybe not the first year, but the next 2 years, right? Housing back significantly. They didn't have to pay any taxes. What does that result in? More buybacks. I won't say dividends, but much more buybacks, better balance sheets, huge cash flow. But if you look at the statistics, they're real. So we get lots of questions about what do I need to see, or what do we need to see when it comes to the economy, for me to change my mind or not to be so nervous about the markets over the next 6 to 12 months. And there are a few things. The Fed needs to address that they are seeing signs of inflation slowing. Doesn't mean that they have to say that they're going to ease, but they have to see something, because right now they're bulls to the wall. It's crazy. And people looking at this, I'm even seeing not a lot, 2 or 3 economists, listen to this podcast, but starting to say, listen, the Fed's pretty crazy. They're looking to go over 4% without even looking at what's coming out ahead. And if you look at the last month and a half, 2 months of data, holy shit, what a difference it was compared to the 2 months prior. Massive. And yes, we're still up. I'm not saying 6-7% inflation. Holy shit. But it's drastically coming down. And it like in a light switch. And we're seeing it industry to industry to industry. We saw it with oil. We saw it with retailers immediately. Holy shit, we have tons of inventory out of nowhere. What happened to those supply chain concerns? Chip market now in a glut. What the hell happened? I thought they couldn't get enough supply. Now you're in a glut. Like immediately it happens. When demand shuts off, it shuts off like a light switch. That's why it's so tough being in the retail business. And people change in days. And it's almost impossible to predict. You try to predict it, but it's difficult. Obviously, the people with the best algorithms in the world, Target, Walmart, Amazon, got this totally wrong. Bulls on the wall producing, holy cow, we got to get our supply chains better. And they did a great job and then got all this inventory, and holy cow, demand out of nowhere stopped. These are the guys that know everything about everyone in the world, and they got it wrong. Now, the Fed needs to address this. Hey, inflation is slowing, but we're going to keep our eye on it. That would be good. We're going to get a hot CPI number based on rents, which are starting to come down, but will take time. And rents are fixed, right? They go up year over year. Yes, they're up significantly year over year. I think month over month is starting to come down. But it's not like, holy cow, food, I need to buy it. It's not like your rent's going up every single month. It's getting adjusted maybe a year or maybe 2 years, 3 years, depending on your lease or whatever. But it's going to take a while for that number to come down, which means it's going to be a hot CPI number. So hopefully the Fed doesn't just say, hey, okay, high CPI, we need to come down faster and we're going to raise. They continue this rhetoric of we don't see any signs of inflation slowing. we're going to continue to aggressively raise rates into next year to control inflation no matter what, it's going to be terrible for equities. It's going to be horrible for equities. You know why? Because we're in a zero growth market. I mean, you look at GDP numbers coming down, they're crashing all over the world. And countries are sitting on more debt than any time in their histories. By raising rates, can continue to raise rates, we're increasing the cost of servicing that debt. Is the Fed monitoring that? Are they seeing what's going on with other countries? I mean, Russia's still a wild card. One of the things I would love to see, some easing of tensions. I mean, if this happens over the next 3-6 months, which is unlikely, not seeing any signs of that. We're going to see food prices come down. Also, oil prices pull back even further, most likely. That would be great for the markets. But the data, we need to see data. If you're asking me, what's going to change, we need to continue to see data that's showing inflation is moderating. I mean, you saw PwC come out with a study suggesting or estimating, based on their survey, that 50% of companies in the S&P 500 are going to be laying off workers. I think that number is conservative, since earnings are declining year over year when you strip out energy. And it's important to strip out energy. We're not just taking it and stripping it out like the stripping out food, energy, whatever. But energy is a major component. It's on fire. Without it, we would have saw earnings decline 4% year over year. Instead, they're up 6%. That's the difference in energy, where profits are up close to 300% year over year. 300% for a sector, not a company, a sector. That might make sense to you looking at prices, but 300%? Holy cow. But speaking of earnings, we need to see estimates come down. And you know what? We are finally, like the heavens, finally seeing it. This is FactSet, who reports. I tell you, this is free information. It's one of the greatest reports that you'll get for free, market-related. Just go into Google, type FactSet earnings. They just came out. This is data, I believe, is from yesterday. So analysts have lowered their estimates significantly into Q3, as July and August, which we all know, have been slowing dramatically. So July and August are what? The first 2 months, which are calculated to next quarter's earnings, with September being the third. July and August have been incredibly slow, to where earnings estimates have been lowered by 5.4% in August. That's how much the S&P 500 earnings, when they package them all together, all the earnings, that's how much it's been lowered, 5.4% in August. Those estimates. You don't hear about this. You're only going to hear about upgrades, downgrades, and when they report, you're going to say, did they beat that number? Did they not beat the number? You're not going to know that number was $2, but now it's $1.50, and then they report $1.60, and everybody celebrates and say, wow, they beat by 10 cents. That's what you're used. That's what they're conditioning you to believe. It's still, the number's still $1.60, and it was supposed to be $2. That's my take on Disney when they say they beat the numbers. They're losing more money than they ever lost. Their earnings have not even come close to going back to pre-COVID levels, one of the only companies in the Dow that could say that, outside of Boeing. But yeah, they're beating because estimates have been lowered. Now, let's put that in perspective, that 5.4% in August, because that's just, hey, it's a percentage. It sounds like it's small. Is it big? I don't know. You got to put things in perspective. If you go back 10 years, the average decline in earnings per share over the first 2 months of any quarter, this is FactSet for you, great research, have been 2.7%. This is double that. That's a massive revision. Massive. It shows you that earnings are coming down significantly. So the revisions are more than double the average, and I got news for you. They're going to come down even more. That's why companies are seeing this. If you strip out earnings and you look at the rest of earnings, for the rest of the S&P 500, those sectors, they're coming down. When you see earnings coming down year over year, it means that you're going to probably lay off employees. You have to cut costs. That's the easiest way to do it. And if you're looking at the earnings, it's broad-based. This is 9 of the 11 sectors have seen the estimates cut by analysts, which is a good sign. This means that expectations are being lowered. However, if you look more closely at the data, which I did, and I want you guys to take a look at this. If you're on our YouTube page, you could see it. If not, if you're listening to this, pull it up on FactSet, and you're going to be amazed. Because you look at earnings, they're going to be pretty bad next quarter, to where they've already been revised significantly lower. But we're likely to see this for the next 2 to 3 quarters, where we could see negative year-over-year earnings per share. I would say growth, but it's not growth, which is basically an earnings recession. You're not going to see it because you got to strip out energy. But you know what? Let's bring some of this up, and I'm going to share it right now. So you're looking at the sector level S&P 500. I'm just going to change this input really quick so you can see my arrow on here. So S&P 500 sector level change. Then this is Q3 2022 earnings per share. I'm going to explain everything, even though some people will be watching this way. If you're not watching, you can understand it. If you look at energy, so the sector level change in Q3 2022 earnings per share, right, from June 30th to August 31st. You're looking at energy is up 9.6%. And remember I said 9 out of the 11 sectors? The other sectors, real estate, it's up 0.1%. Now look at the rest of the sectors. Utilities, okay, flat. It's down 0.1%. Financials down 4%. Industrials down 4%. S&P 500 overall, again, down 5.4%. Healthcare down 7.5%. Materials down 7.9%. Consumer discretionary down 8%. Information technology down 9%. Communication services down almost 13%. I mean, this is recession all over it. You strip out energy, you got recession all over this. I mean, it's crazy. So these are the earnings revisions. This is how much, if you're looking at it. On average, it's 5.4%, which will give you a bottoms up. But if you're looking at these numbers, it's insane of the declines that we're seeing, of how they're pulling back finally, which is good. That's a good sign. If we keep going here, there's other things here that I wanted to show you. So looking at S&P 500 calendar year 2022 compared to calendar year 2023 earnings. Okay, this is all the earnings, guys, that are packed into the S&P 500 together. Okay, if you take them all together, they're expected to finish the year at 226. Last year, I believe they closed at 210. So we're still going to see earnings growth this year, despite how terrible the market's been. Do you really think we should be seeing earnings growth? No. A lot of that is energy. But 226 is a big number. But more importantly, they're expecting 2023 to be 243. So $243 in earnings with all the S&P 500 companies together. That's over 7% growth. And at 226, that's 7% growth from last year. In recessionary times when GDP is slowing, where companies are looking to lay off employees, where you're seeing inventory concerns, now you're seeing supply chain gluts in semiconductors, you really think earnings are going to grow close to 8% annually over the next 2 years, this year and next year? There's no effing way that's going to happen. There's no way that's going to happen. I mean, it's crazy when you think about it. But you get to net profit margins, it gets even crazier. Right? Net profit margins. People are like, oh, well, we have to raise prices. We have to raise prices no matter what because of inflation. It's amazing. Net profit margins are incredibly high. They're higher than the 5-year average. They're well over 12%. That's something I could show you as well. But if you're looking here, energy was the largest contributor. So when you look at net profit margin for the S&P 500, you're like, well, they're keeping up with their margins, which is good. That should be good for stocks. Yeah, but you got to break it down further. Because if you look at energy, their profit margins went from 6.5% to 14.4%. It's a major percentage, a major part of the net profit margin of the average. But they even say, on the other hand, 9 sectors are reporting. I've reported a year-over-year decrease in their net profit margins in Q2 2022 compared to Q2 2021. 9 out of 11 sectors, right? And that's right here on the FactSet report. 9 out of 11 sectors. Again, YouTube, absolutely free. You can see the charts. I like bringing this stuff up when I'm going through it. That's pretty crazy. You're seeing profit margins. What does that mean if profit margins are coming down? It means that you're not seeing inflation. Yeah, you're seeing it in energy. Energy prices have come down. They're still up year over year. Again, they're going to be stubbornly high, even at $86, but natural gas prices are through the roof still. Still close to their highs. They're $8.50, and I think $9 with their highs, whatever. And forget it where they are in Europe. I mean, I don't mean to laugh. I'm laughing sarcastically, but holy shit. I mean, it is crazy over there. It's a crisis. I mean, people could die because they're not going to have the energy to heat their homes during winter. It's crazy there. It's absolutely crazy. But you're looking at those net profit margins, what does it tell you? It tells you that the Fed rate hikes are working. They're working, but the Fed is just totally blind. I don't know if they're blind or it's just Fed speak because they don't want to stimulate the market. They don't want money to right away. Holy cow, let's go. It's going to go higher. Everybody's going to be all in. No, I get it, but they are really, you don't have to go that far and say no matter what, they're going past 4% and we're not even going to ease them for the next 16 months like they can predict more than 3 months. We've seen the Fed's track record over the past 2 years. It's the worst. It's the worst ever. If you had a 4-year-old kid, they would have predicted the market when it came to inflation better than the Fed. It's a joke. You're supposed to be the smartest guys in the room. I mean, you couldn't have been more wrong than them. But you're looking at profit margins, right? I mean, the data is there for the world to see. Earnings and profit margins for 90% of the sectors in the S&P 500 are declining year over year. And it's going to get worse just where rates are right now. Think about that. And the Fed wants to continue tightening. So you have to be careful here. And look, we got familiar with the term for 10 years. Don't fight the Fed. Don't fight the Fed. Don't fight the Fed. Zero interest rates. All the bears telling you, the market's going to crash, market's going to crash. When you have a printing machine that's on 24 hours a day and it doesn't matter, it was a buy the dip mentality. But don't fight the Fed is not just a bullish term. It shouldn't be used just for bull markets because you can't fight the Fed here, right? I mean, it was used a million times against those bears, or millions of times. The market's going to crash, right? When you have zero interest rates, massive money printing, quantitative easing. It wasn't going to happen. But now look, I mean, buying stocks here, you're fighting the Fed. A Fed who says interest rates are going to go significantly higher from here. That's what they said. They said, we will be shrinking our balance sheet. Taking more dollars out of the economy, you're going to see it right now. Starting now, you're seeing it. Going forward. Whatever it is, 90 billion, 100 billion. A lot of shrinking to do. I won't get into the dollar. Dollar being higher helps that a little bit. But, and put in perspective, we're looking at the balance sheet increasing by 4 trillion to what, 9 trillion over the past year. You could do the math on it. If you're taking, say, 100 billion out of the market a month, what is that going to do? What, 1.2 billion after a year? 1.2 trillion. So 4 trillion. You're looking, I mean, you're not going to shrink it by that much, but it just goes to show you it's just another drag. It's another drag in the economy. You have to realize the Fed here, this is the Fed. This is a market about the Fed. Can't look at earnings. Can't look at Russia. It's the Fed. It's 100% the Fed. If you're going to buy equities, the Fed. It's the Fed right now. That's all you need to be focused on because they are God when it comes to the markets. They control money. They control the world. If you don't think so, look where the dollar is right now against almost any other currency outside of the ruble, which is mind-boggling. The euro's at 20-year lows against the dollar. Yen is at 24-year lows against the dollar. Yuan's at near a 2-year low. They're inflating it. When did you ever see China inflate their currency? They're telling their banks they can't hold as many foreign currencies. Foreign dollars at banks. Hold your own currency. When do you see that? Holy cow. That's not a sign that China's horrible right now. I don't know what is. But for me, you got to look at September. September is extremely important. This is where the Fed, and this whatever, 21st, whatever date that is, right around there. You could check it. I'll be letting you know exactly what that date is going up to as we get closer and closer. But the Fed's going to raise rates by 50 basis points. They're not going to do 75 basis points. I don't think so, unless they're complete idiots. They don't need to. But the rhetoric around that is very, very important. The Fed speak is going to be significant. Because even as we look at the markets today, I mean, they're trying to catch a bid, as the technicals suggest. We're given oversold conditions, and it looks like the market's going to bounce back really quick, and then pull. Whatever the technicals say, I don't care about the technicals. I really don't. You want to trade the market, trade the market. I care about the next 6 to 12 months. But what do we see? So the market tried to catch a bid today and then pull back by 10 o'clock, and now might be up a little bit, back and forth. But, you're seeing this, sell into strength opportunity. Sell, sell, sell. Remember, it was buy the dip, buy the dip, buy the dip. It seems like every time we got strength, it's sell into it because there's so many uncertainties. Again, Europe is a disaster. China is horrible. The property market is terrible, is crashing. They're trying to hide as much as they can. They can't. There's too many people that are fed up that are actually reporting and getting their news out. Just like they did during COVID, finally. How many people reported that disappeared from Wuhan that were reporting saying, we got this virus here in December. People are dying. All the hospitals are full. We don't know what's going on. Yet China did the most wonderful thing in the world. They closed travel to the rest of the world, to all of China from Wuhan. But if you live in Wuhan, you could travel to the rest of the world if you want. That's okay. While they were preaching for the next 2 months that, hey, this is a contagious. It's not human to human transmission. That's what they said. And they even got the WHO, who's on the payroll, to buy in and say, wow, China was the best. They were amazing. They were unbelievable with their response. You can hate Donald Trump, but the one good thing he did was cut funding to that piece of shit organization. I mean, give me a break. They weren't even allowed into China, and they said that. China would not let anyone in to help them out. Countries were like, listen, we'll help you. Let's see what's going on. They're like, no. No, isn't that a sign? Doesn't that tell you where it started? But you're going to believe China, what's going on right now? It is horrible, terrible, being underreported still. It's a disaster. People are starting to rise up against the government, which never happens. Can't get your money out of banks. Shit's frozen. Still lockdowns over COVID. I mean, you'd think they would know more about COVID than anyone. Why are you locking down during COVID? Which is a cold for most people, and we know who to protect. You know, you created it. You should know all these stats. Come on. Why are you closing down everything? It's a disaster. It's going to be interesting to see how much of the metals and things and steel and everything else that they're going to be dumping on our market because they have such a surplus of it right now. Let's see. When it comes to the Fed, that's the biggest question mark. Because I'm struggling to find any growth catalysts. Any. I mean, again, Europe, China, you look at Russia-Ukraine war. I mean, is South America going to pick up the world? No. It's all about the U.S. The Fed's doing everything in its power to slow growth further, which is insane right now. You may say, Frank, what about the catalyst where stocks are cheap? Are we cheap? I mean, some sectors and individual names are no doubt cheap. But if you're looking at the S&P 500 as a whole, earnings are coming down. Estimates are coming down, which means that the S&P 500 stays where it is. Right? Stays where it is. The forward PE is going to go higher. It gets more expensive since the earnings estimates are going lower. So you would think we would be trading at 15 times earnings. We're still trading at 70 times forward earnings because earnings are being revised lower and lower and lower. So for those of you who think the S&P 500 is going to go up, as it goes up and earnings go lower, it's going to get really, really expensive pretty quickly. But at 70 times forward earnings, that's around the 5-year average. We're not dirt cheap. We're not like super cheap where you're buying pennies, assets for pennies on the dollar. So it's all about the Fed right now. That's everything. That's what's confusing. That's what people are people like me months ago seen the bottom of the market saying, hey, you know what? It's a good time. Go all in. The Fed's definitely going to change it to September. But man, Jackson Hole and what they said and how every one of them were on board and confirmed and just listen, they were going 4%, 4.5%. We might go higher. Holy shit. Are you not seeing what's going on right now? Are you really not seeing it? It's absolutely crazy. But that's what the market's looking at right now, the Fed. It's the only thing it cares about. They should never fight the Fed. Not just when the policy is easy from the Fed, but also when it's tightening. You still have to be cautious here. With that said, I am picking away at some biotech names and crypto since these sectors have been annihilated. Some of these names are down 75, 80% still. Much more than the markets. And the Fed goes balls to the wall and says, you know what? We are raising rates. We're going to continue to raise rates. Yes, some of these names are going to get hit. Probably not as hard as the rest of the market because they're down so much. There's lots of great biotech names trading below net cash right now. However, if the Fed just hints and says, look, we're going to look to tighten, but we're going to look at the data. Right now, the data is clearly showing that inflation is moderating. It's still too high, but it's a good sign that we're seeing it moderating. That's a totally different tone than we don't see any sign at all, and we're going to pedal to the metal. That's a big difference. And the Fed does that first option and says, look, we still see inflation. We're monitoring it. We're not going to do anything stupid here, but we are seeing what we've done already. We've seen the effect. They're working. That's going to be a boom to the market. And the stocks that you're investing in right now, I would throw crypto in there. I would throw biotech in there. And I would throw small caps in general in there. Because, man, there is some great great companies in there trading at dirt cheap valuations. Again, when you have deleveraging, this is what happens in markets when you have deleveraging. It doesn't happen often. It's every 10 years, 15 years or so where you see this massive deleveraging, people over leverage, and they got so much money in the market, and it creates forced selling of even good assets that come down tremendously, just like we saw with the housing crisis in 2010. I live in Fernandina Beach, Amelia Island, and when I moved here in 2010, 90%, probably more than 90% of the homes on the water, right over here on the water, probably maybe 100 homes were for sale. Because you probably had 3 or 4 different buyers that were leveraged, no money down, that bought all these freaking properties, and they just walked away. So I'm going to walk away. I don't have anything down. You kidding me? These things are down 20, 30%. They gave them to the government. Those houses, they were probably going, some of them for $400,000, $500,000. They're probably $2, $3, $4 million, some of these houses. Maybe $1.5 million you can get for a cheap one that's on the water, which is the ocean. It's not the bay. But that's what happens. You only see those major disconnects when you have a deleveraging process. And you're seeing that in small caps where people just, running away from risky assets. That's what happens when you move money from the market. That's biotech. That's also cryptos. And I'm not talking about buying, stupid cryptos with utilities that have no utility function. I'm talking about the good names. The top 20, 30 names are down significantly, and they are really good names. They have utilities and everything. Very, very good names. That's where I'm looking. Because if the Fed does change its tone just a little bit, these things are going to go up 2x to 3x in probably a 6-month period. And if they do that, they're still going to be trading below their 52-week highs. That's how low they are right now. And they went from 10 to 2. They can go to 6 or 7. And again, they're still well below their 52-week high 10. That's what you're seeing in this area. That's what you're going to be seeing in a lot of my newsletters. But you have to be cautious. I'm not telling you to sell everything and go nuts. But if the Fed comes out in September and just says, the same rhetoric, the same exact tone that they had in Jackson Hole, watch out. Don't be surprised if the market pulls back another 10% through the lows, and it's going to get really, really ugly. And then maybe the Fed will realize, oh, wait, okay. We do see signs. Because there's signs everywhere that inflation is moderating. Everywhere. There's also a sign inflation is not moderating in a couple of things. Like I said, food, energy. But if you look at so many things, holy cow. And you just talk to people out there, you're starting to see it. Wait to the holidays. They're coming up. Wait to the holidays. Wait to Black Friday when you see you're buying TVs for $250 on a 55-inch screens, flat screens, 4K. Then you're going to realize how much inventory supply these guys have and how much they have to dump it. Hopefully we don't have to wait till then. We'll see. Any questions or comments? I'm here for you. It sounds a little dreary, but I'm being real with you. Again, picking away at some of the things that are down a lot. The Fed should be your main concern. That's the only thing right now. That's the growth catalyst. That supersedes everything else. Russia, China, everything else. If the Fed reverses its tone. If not, if you throw in all the other risks and pile it up, it doesn't look good for equities. It doesn't look good for any asset class. Any asset class other than the dollar, which is why it continues to surge. Guys, questions, comments, frankcurzioresearch.com. I'm here for you. Really appreciate all the support. I know I say it all the time. I truly mean it, guys. Thank you so much for listening to the podcast, trusting me, subscribing to our products. Try to provide the best research out there for you guys. But I really, really appreciate it. Again, thank you so much for all the support. I'll see you guys tomorrow. Take care.